How is a fixed income team preparing for shifting markets and rising economic uncertainty? Hi, I'm Samuel Martinez, and this video will share how we're positioning portfolios, what developments we're watching, and how advisors can help clients stay confident in this environment. Well, the government shutdown continues to be a theme in markets in general. Of course, we expect that to be a slight drag to growth. But another factor that's been a little bit of a challenge for market is navigating without the data that the government provides. So this has introduced a little bit of uncertainty in markets. Nonetheless, we feel good about the underlying trends and don't think that's going to have a long-term material impact in terms of markets at this point in time. Another risk that we're paying attention to is the recent flare-up in trade-related volatility. Of course, it's reminded markets that we are not out of the woods on this front. We have further things ahead of us to resolve. And we expect that to continue to progress, but it's going to be a theme. Another emergent theme that we saw last week in particular was several lenders having some financial troubles and going into bankruptcy. It's really put the spotlight on private lending, and of course, a corollary to that is bank asset quality. That continues to be in focus for the marketplace. The impact on banks is critical because risks that materialize in a small way that impact the banking sector can really have a broader impact on markets. So that's something that we're paying attention to. Now, of course, there are other factors that are supportive of markets. Growth remains modest but positive. There's been enormous CapEx spending related to technology and AI. And we've also seen a short-term fiscal boost from the One Big Beautiful Bill. These are things that are supportive of growth. The Fed is primed to ease going into year end. They are being responsive to slowing growth, and they're being responsive to some of the slowdown in labor market that we're seeing. That's great news for markets. There's also reason to believe that trade concerns can be lessened over time as rhetoric softens. We saw that materialize towards the end of last week. And then, of course, as trade negotiations continue to work their way out. Q3 earnings also kicked off last week. Initial results from the banking sector looked very good. This leads us to believe that some of the noise around these loan hiccups and lending hiccups appear to be just that for now, but we're going to continue to keep a close eye on that. First of all, there are a lot of risks out there. We know that valuations are tight and that prices reflect a lot of positivity about the direction that we're headed. Put all of the risks together with this positive backdrop and supportive aspects of the backdrop, and it's leading us to be cautious. We have an up in quality bias. We have lower credit risk than our typical baseline, and we're keeping our duration relatively close to home, but acknowledging the fact that this can really be a diversifier in this environment should any of these risks materialize. Now, that's our positioning today. Of course, we are focused on delivering value to our clients through cycle. And one of the key tenets of this is that no matter what cycle we are in, there's opportunity available if we're positioned to take advantage of it. A lot of people talk about average spreads. That's one number. It's important to remember that there's a whole range of spreads around that. Different issuers priced at different levels for different reasons. Our team goes deep to be able to identify those issuers where opportunities exist and are going to support generating value for our clients, but they also pay close attention to avoid those issuers who are priced to perfection and will probably realize more downside risks should the market turn around. This deep specialization and sweating the details is really important. For example, our bank research team has been monitoring non-depository financial institutions' loan disclosure. This is the part of disclosure that relates to some of this noise in the lending market that we've been hearing. More detail was required in Q1 this year, And we have been pressing banks for even more disclosure. This has prompted us to be more cautious on certain banks, well before the recent headlines broke. Advisors should be particularly aware of making sure they're peeling back the onion and considering all of the details of the investment opportunities that they're pursuing on behalf of their clients. It's easy to lose sight of the fact that with all of the risks at play, one, there are some positive offsetting factors at play, and then two, your starting point matters a lot in fixed income. Yields are attractive, and yields are one of the best predictors of returns over an intermediate or longer-term time horizon. It's important that you and your clients keep that in focus as you're navigating this environment. Higher yields can provide more return to offset short-term hiccups. That's one of the ways fixed income can be particularly helpful at this point in time. Another key consideration is making sure that you get portfolio construction right based on what you're trying to accomplish for your clients. And then, of course, more holistically, you want to make sure that you have the right mix of fixed income, both active and index, to complement the rest of your portfolio to make sure that you're driving the outcomes you want. Fixed income can really be a great portfolio tool at this time. Despite some of the challenges, it's critical to keep that in focus as you plan for the future with your clients. Be sure to like this video and subscribe to this channel for more insights from Vanguard's thought leaders.